Hello and welcome everyone to our Pitcher Partner session on the JobKeeper provisions. My name is Alexis Kokkinos. I'm a tax partner in our National Tax Division. And today I'm joined by Leo Gouzenfiter and Chanel Palmer, who will be co-presenting today with me. Today's session is our third part of a series covering the JobKeeper provisions, and in particular, we're covering the alternative decline in turnover tests. Now, if you have missed any of the previous sessions, the last two sessions, they have been recorded and you can obtain a copy of those sessions if you'd like to go through the materials. They have covered the basic tests, the basic decline in turnover tests, as well as the GST attribution requirements in applying those tests. So those are the two sessions we've previously presented on. Today we're going through the final part of the package, which is the alternative decline in turnover tests if you don't otherwise satisfy the basic tests. So what are we covering today? We're going to do a brief recap of the the basic decline in turnover test. So what we presented in our first webinar, and just explain what the new rules are for the two extension periods. We're going to then talk to these alternative tests. For example, if you fail the basic decline test, what you're allowed to apply as some alternative tests for the two extension periods. And finally, we're going to just cover off on the Pitcher Partners calculation model that effectively can allow you to do all those tests once you input all your GST data. So please stay until the end of the session. I'm going to cover our model that we have, a package that can assist you in the calculations, and we're providing that to clients that we're assisting in terms of reviewing their GST decline in turnover calculation. So I'll cover that at the end over 5 minutes. So just as a recap to the JobKeeper 2 provisions, which we're going to use throughout this session. So everyone's familiar with the original JobKeeper scheme, which was for 13 fortnights ending the 27th of September. So that those fortnights have all completed, and we're now moving into the new JobKeeper provision, so JobKeeper 2. We have two extensions that are covered for 7 fortnights under the first extension up to 3rd of January 2021, and then we have another 6 fortnights that go all the way to 28th of March 2021. And as we've previously presented on, the eligibility requirements are required. You need to satisfy the decline in turnover test in all of the 3 periods in order to qualify for the JobKeeper provision. So if we're in the extension period number 1, which covers 27th of September 2020 to 3rd of January, you do need to have the decline in turnover test satisfied, and it references to the September 2020 quarter versus the September 2019 quarter. As we've previously mentioned, new entrants are permitted. So if you've never claimed JobKeeper, you can come into the new extension regime, but you do need to satisfy the decline in turnover tests that apply. One of the big changes to the new JobKeeper 2 provisions is the decrease in the amount of subsidies that are provided. So there is new higher rate and lower rate subsidy provided, which essentially looks at whether an employee has worked 80 hours in a reference period, which is generally a 4-week period up to 1 March or 1 July. And the rates are for the extension period 1, we're going to a $1,200 for higher rates and $750 for lower rates per fortnight, and then moving to $1,000 and $650 for extension period 2. So there is a winding down of the subsidy that is being provided under the new JobKeeper provisions. Now, importantly, in calculating the decline in turnover test, essentially what we're looking at under the extension periods is we're looking at the actual GST turnover, and we're looking at it for a quarter, and we're comparing it to the prior year's quarter. So for the first extension period, we're looking at the actual GST turnover for the September 2020 quarter, and we are comparing that to the September 2019 quarter. And you need to have a decline in your turnover of at least 30% if you're a entity with under $1 billion of turnover aggregated, or it has to be greater than 50% decline in turnover if you've got $1 billion plus turnover. So you need to satisfy the threshold decline in turnover in order to access the JobKeeper under the new extension provisions. For the period of the second extension, you're then looking at the December quarter turnover and comparing that to 2019 to make sure that you've declined in turnover at the has to exceed, at least equal or exceed the specified percentage that I just went through. So just a basic example to demonstrate that test and the complications that may occur and why you might need an alternative test. So in this first example here, we've got BizCo. It commenced business on the 15th of October 2019, and it's currently got 1.75 million as turnover for the September 2020 quarter. So straight up, you'll see, because it's started business on 15th of October, it obviously doesn't have any turnover for the period that is the comparison period, being 30 September 2019. So it's impossible for it to test the decline in turnover for September 2020. It just doesn't have a comparison period. When we move to the second extension period, obviously we've only had a couple of months of trading. So we've only started trading on the 15th of October. We've only had a couple of months trading. But again, when we compare the December 2020 quarter to the December 2019 quarter, it's showing in our example an increase in our turnover. And that's simply because we started business last year during that December 2019 quarter. So it's not really showing the real impact of COVID on our turnover that we're currently facing. So if we only had basic tests, essentially this entity would be excluded from applying for JobKeeper in the extension periods. So what do we have? Essentially, under the rules, the Commissioner has a power to set alternative tests for a class of taxpayer if they're satisfied that the comparison period would not be an appropriate period for it to test. So the Commissioner can go out and set circumstances where he believes that the comparison period isn't an appropriate comparison period and set out alternatives. And that's a legislative power. The Commissioner has read down this legislative power, and therefore the only thing that he's willing to provide alternative tests is if you can satisfy a condition to say that your comparison is not appropriate. So he can't set any new rules for doing new decline in turnover tests or anything like that. He's just saying that he can only determine when he believes a comparison period is not appropriate. And if you fall into that criteria, he'll give you a slightly different test to determine what your comparison amounts may otherwise be. So this hopefully isn't news to everyone. These alternative tests existed under JobKeeper 1, and predominantly there was four main tests that the Commissioner provided alternatives for. The first was if your business had commenced on or after effectively the comparison period, then essentially you could use a business commence test. If you had an acquisition, disposal, or restructure, again after that comparison period, that may have increased your turnover subsequently so that your current period has been inflated by that transaction, then again you could choose an alternative period to test against. A third test was you would look at whether you'd had substantial growth in your turnover up until essentially the COVID period. And if you had that growth, again, using a comparison period, which was 12 months before your current period, may not have been reflective because you've had substantial growth over the last 12 months. So again, you got to select a different comparison period. And finally, there was an irregular turnover test, which essentially looked at the quarters in the last 12 months and had a look at whether you had an irregular period. And if you did have a very large irregular period, then essentially it allowed you to smooth out your turnover and use that as a comparison. So the Commissioner had provided 4 alternatives in the old JobKeeper provisions. Now, Pitcher Partners reviewed those alternatives coming into JobKeeper 2, and we noted that there was a lot of the provisions in that legislative instrument that didn't actually work under the proposals of JobKeeper 2. So we proactively in August sent a submission to the ATO, outlined all of the interaction issues that we believed would be the case. It was a 15-page submission. and we outlined all the interaction issues that we believed would occur under JobKeeper 2. The ATO took that submission and essentially nearly updated the rules for every single item that was provided by Pitcher Partners. So the ATO did a fantastic job in agreeing with those being issues under the JobKeeper 2 provisions and made some quite clever amendments to the document, which enabled the ATO to release this last week, which was probably a lot earlier than what it had done in the previous JobKeeper provision. So they're able to update it, make sure it worked under the new JobKeeper provisions, and release it quite early so people are able to use that in their testing right away. So what are some of the main changes that have happened? So essentially, there's been 5 main things that the ATO have changed, and we're going to go through each of the tests in detail to demonstrate what those are and how they can be beneficial. But essentially, what they did was, in the first case, they made an extension to cases effectively where certain events occurred during the relevant 2019 comparison period. So under the original legislative instrument, if you were testing comparison period, you had to look at events that happened after the comparison period. And one big change was the comparison period became a quarter rather than a month, which excluded a lot of entities from applying these tests. So what they've done is they've moved the testing period. So you just need to look at the start of the comparison period, not after the comparison period. So it's brought in a lot more cases that can use these alternative tests. Also, the old alternatives effectively kept moving in terms of when they applied, and they started bringing COVID periods. And obviously, when they started bringing COVID periods as a comparison, automatically the turnover started decreasing, and it gave some funny results. So essentially, now we've got an ability to exclude the COVID periods from the testing. So they've brought that in for almost all the tests. And they've come in by virtue of providing options in terms of doing that. As noted by dot point 3 there, the substantial increase in turnover, regular turnover test, they've effectively provided a choice where you can choose up to 1 March as your cutoff date in order to rule that off. So you get 2 options, one to look at your COVID period or one to rule it off at 1 March to deal with that previous issue. I'll just jump to dot point 5 because what they've done in respect of the disposal acquisition restructure date is they've done 2 things there. They've essentially said that you don't have to apply that rule during COVID, so you can choose to have any transaction you want and look at them independently. And they removed this sequential test where you had to effectively look at the very last transaction that had occurred. So they've provided pretty much a maximum amount of options here where you can look at whatever transaction that may have changed your turnover and choose that one in terms of determining your comparison. We'll go through this in detail, but it's quite a massive change. It has greatly simplified the way it will apply and also removes some ambiguous results or some uncertain results where you have had a transaction during the COVID period. The 4th dot point there is there were some ambiguities that were contained in the last legislative instrument in terms of what quarters do you actually test or what period do you test when you're doing the regular turnover test or the substantial increase in turnover test. So we raised those issues and the ATO were good to clarify those and make it more certain about exactly which periods they're testing. Both those have aligned exactly with how Pitcher Partners had been interpreting the provision. So the ATO have clarified those in line with our thoughts. So with that being said, I think we're going to move to the alternative test. So I think I'm passing over to Chanel, who will take over the presentation from here.
Thanks, Alexis. Good afternoon, everyone, and thanks for joining. So as Alexis has already outlined, the alternative tests remain available largely to the same broad class of entities as under the original scheme. There's a few important modifications that we'll take you through when we discuss each of those tests in more detail. We'll be focusing on the 4 that we've listed on the screen, which we think are the 4 most common scenarios that you'll encounter. But before we start, just 2 quick important reminders. First, the alternative test only needs to be considered if the basic test isn't satisfied. So even if you fit within a class of entities as described in the test, the use of those tests is optional. So if you meet the actual decline in turnover using the basic test, you don't need to retest under any of these methods. Secondly, the tests have one important limitation in common, and that is that they only apply to substitute turnover of the comparison period. So the period in 2019. Their broad application's the same, so each test has a set of criteria to establish whether an entity fits into the test. And then we often refer to that as a gateway test. If you can establish that you're within the relevant class of entities to which the test is directed, then you can apply the alternative test. And essentially what this does is substitute the turnover for the September 2019 quarter or the December 2019 quarter, depending on whether you're looking at the first or the second extension period. Regardless of the test that applies, you still use the September 2020 quarter or the December 2020 quarters as your test period. These don't change as a consequence of the alternative tests. So if we look at the first test, switching to the next slide. First test is for newly commenced businesses. This one's pretty straightforward, pretty much applies in the same form that it did under the original JobKeeper. If you're testing the decline in turnover for September 2020 quarter and you started your business after September 2019, then the comparison period is clearly not appropriate. As Alexis foreshadowed earlier, key change to this test from the original version is that it's available to businesses that started during the comparison period. So if, for example, whereas before, if you're looking at September 2020 quarter, if you started in, say, August 2019, the test wouldn't have been available to you because you started before the comparison period, or during the comparison period, I should say. This clearly doesn't give you the right outcome because you're not comparing like for like. You're essentially comparing the quarter where you traded for only part of the period against the quarter where you traded for the full period, meaning it's already harder to satisfy the test even with a decline because of COVID. So this is a really good change from the ATO's side. What this means is that the test essentially applies if you commence business after the 1st of July, if you're looking at the September quarter, or after the 1st of October 2019, if you're looking at the December quarter. It is important to note the slight difference with the other tests that apply where the relevant event happens on or after the relevant comparison period. So here, if you start on the 1st of July 2019, it won't be available. Presumably the logic behind this is that if you do start on the 1st of July, there is an appropriate comparison period. It's a little bit questionable, as if the entity's just started, you might question how comparable it would be and whether you would satisfy the basic test. However, doesn't it stop you applying some of the other alternative tests? So we've outlined the detail of the tests on this slide. As I said, the test applies to an entity that commences business after the relevant comparison period, but before the 1st of March 2020. Unfortunately, if you commence business after 1st of March, the test won't apply to you, but then neither would JobKeeper, because it continues to have a requirement that you were carrying on a business as of the 1st of March 2020, or if you're a not-for-profit, you were carrying on your objectives principally in Australia as at that date. This is one of the most concessional alternatives that the Commissioner provides because there are two options available to you. The first option looks at the average turnover over the period in which the entity was operating the business prior to that 1st of March. So under this approach, you basically take the average monthly turnover and multiply it by 3 to give you a representative quarter in which to compare the 2020 turnover. For businesses that commenced in February 2020, there's an adjustment which essentially just calculates the average daily turnover and multiplies it by 29 to get an estimate of what a full month's trading would have been. The ATO's also provided an alternative which just takes the total of the turnover for the 3 months prior to the 1st of March. So you just total December, January, February, nice and easy, and use that instead. But obviously you must have traded for the entirety of that period. So we'll go through just a really brief example. Alexis took us through a recap of the basic test where you had BizCo commencing business on the 15th of October 2019. In that scenario, BizCo couldn't have passed the actual decline in turnover test because there was no turnover for September 2019 quarter, meaning that no matter how affected by COVID your business had been, you'll always have an increase from 2019 to 2020. So in this scenario, it's really clear that BizCo is entitled to use one of the tests provided by the Commissioner as it started its business after the 1st of July 2019. If we take the first option available to us, BizCo would take the average of the turnover for November, December, January and February to arrive at an average monthly figure of $730,000. The month of October is excluded from the calculation because BizCo didn't operate its business for the whole month. But however, in this instance, BizCo wouldn't satisfy the decline in turnover test because the turnover for September 2020 quarter being 1.75 million doesn't fall short of that comparison by at least 30%. So your comparison figure in that instance is 2.19 million. However, as we've just discussed, there is another option available to us, which is to look at the total of the 3 months prior to the 1st of March 2020. In this case, BizCo will satisfy the test because September 2020 quarter, again, being 1.75 million, is 35.19% lower than the comparison figure of $2.7 million. So you can see that having the options available to it does allow BizCo some flexibility in satisfying those tests. A couple of the watch outs to finish on. The explanatory statement clearly states that this applies to entities that were not carrying on any business. It doesn't apply to an entity that was operating one or more businesses and commenced a new additional business. In such a case, you'd need to look at some of the other tests, such as the next one that Leo will discuss about acquisitions. But it does look at when you commenced a business, not when, for example, the entity was first registered. So you could have registered your company sort of prior, like, June 2019, but you didn't actually commence the business until a couple of months later, in which case you would satisfy that. In addition, as we've already spoken about, doesn't apply to businesses that commence after the 1st of March 2020. Again, this is just a requirement of eligibility for JobKeeper, so it's just tying into that. Finally, while the test provides an alternative for businesses that commenced anywhere up to the 29th of February 2020, there will be some businesses that still lose out. So particularly if you're wanting to claim for an eligible business participant, so if you're a sole trader wanting to claim for yourself, or a company wanting to claim for a shareholder, for example, there's an additional requirement under the general JobKeeper rules, so outside the alternative tests, that there be either assessable income for the 2019 income year or taxable supplies for a BAS period that ends before the 12th of March 2020. In most cases, if you've commenced a business, you're going to either be an annual lodger or a quarterly lodger, meaning that your first BAS period is not going to end prior to this date. It's going to end either at the end of March or at the end of June 2020, meaning you'd still be excluded. So it's just something to note, but you'd still be able to claim for any eligible employees. You just wouldn't be able to claim for a business participant. So that is something that does tend to trip people up a little bit. And on that, I'll hand to Leo, who's going to take us through the acquisition, disposals and restructures option.
Thanks, Chanel. Good afternoon to everyone listening in today. So as Chanel mentioned, I'll be talking about the next test, and we've kind of lumped it into one category: acquisitions, disposals and restructures. Now, technically, this is two separate sections in the Commissioner's legislative instrument, and they're two separate tests. Technically, the one deals with acquisitions and disposals, and the other one deals with restructures. But as Alexis spoke about, they've been modified slightly. So effectively, they're almost identical, whether you're dealing with an acquisition or disposal or a restructure. Now, there might only be some very, very subtle differences in that we can see the acquisition or disposal must be for a part of your business, but a restructure can be for the entire business or a part. But for all intents and purposes, they're pretty much the same. The idea is there was some event, some intervening events, like a big acquisition or disposal or a restructure, that makes the 2019 comparison period not really appropriate, and we can maybe use another period to test against our, let's say, September or December quarter's turnover for our decline. Now, one of the elements to access the test is that there needs to be, this event needs to have changed the entity's turnover. Now, it doesn't really say how much, doesn't say substantial, doesn't say significant, but if it's a 1% change or a few dollars change, you're probably pretty hesitant to rely on that. And the idea is that there was some event of significance that caused the business to change so that the comparison to last year isn't appropriate anymore. And the explanatory statement talks about a large change. So again, it's a bit of a grey area, but I guess to be within the spirit of the rules, you'd want to substantiate there was a change that had some materiality behind it. So the as Alexis mentioned, the one of the key changes involved being able to use and look at events that happened after the start of the comparison period. Now, originally, we could only look at acquisitions, disposals, or restructures after the end of the comparison period. And this was a change that sort of we pushed in our submission, that given that we're comparing to 3-month periods, we can look to any events from the start. So from, let's say, 1 July, rather than having to wait till 1 October for any acquisition, disposal, or restructure. And also the rule about sequential acquisitions and restructures was scrapped, so we don't have to work out when the sequence started and ended. We can, if there's 5 acquisitions or restructures within since, let's say, 1 July last year, we can look at any of them and then access this test independently, so effectively giving us multiple goes at it. So it's far more generous for entities. And so this is the test we set out on this slide. Reiterate, the acquisition, disposal, or restructure of part of the business happened after the start of the relevant 2019 comparison. That changed the turnover. So this is the gateway, and if we can get this gateway, we can get a alternate comparison period to test for our decline. And this last point on the slide, it's this kind of no whole month rule, which recognizes that, well, there might not be a whole month after the relevant transaction before our test period. So if we're testing the first extension, we're looking at the September 20 quarter, which starts on 1 July. So if there's a transaction that happened in June, we can't pick up the whole month after June, because then we're kind of using the month that's within our test. We're sort of testing against our we're using a comparison period against the test period when they're both, there's an overlap there. So that one, you can actually use the month in which the transaction occurred if there's no whole month between the transaction and the test period. And we'll go through some examples of these. And we've just got a slide here where, and we'll just talk to you, what are these concepts? Because here it looks like we've got something you might colloquially talk about as, this is an internal group restructure. We've got production co and warehouse co that transfer their businesses over to merge co, and then starts operating a merged business. So what's the key point is that acquisition, disposal, restructure, none of these words are defined at all in these rules, and they should probably take their ordinary meaning in the context of the rules. And while we might speak this as a restructure, like the question, well, is that the case? Look, the ATO do appear to be taking a broad view, but one thing that's clear is that it needs to be a restructure of an entity's business, not a restructure of, let's say, ownership. So, for example, here, merge co could be a new SPV. So we might say, well, it's not really restructuring his business. It's a brand new business or a brand new company that's acquiring two business. So maybe we use a business commence test, which might give us a different result. So, and the other two may be disposing of a business. So maybe they can say, well, there's a disposal, but if they dispose and liquidate, they're probably not going to be employing anyone going forward to access JobKeeper. So the key is, we need to think about, well, do we actually have a acquisition of a business, a restructure of a business? It's not quite clear, and it's depending on your situation, there might be some more consideration need to be given. The explanatory statement has an example regarding restructures where they talk about a company merging operations of two of its business divisions. And also they talk about separating out the managerial and HR operations of this new merged business into a separate division. So it's all sort of happening within one corporate entity. We're not moving assets around, we're just restructuring the way a company conducts business. And in this explanatory statement, each is considered to be a restructure for the purposes of this test, and we can independently access the test under this alternative decline in turnover. But again, we could end up in a situation where we might be actually acquiring a business rather than restructuring. So you really just think about these closely, depending on what the transaction actually is. So let's go through a couple of basic examples to demonstrate. Here we have BISCO again, using the basic JobKeeper 2.0 test. The September quarter turnover only fell by $800,000 or 23.52%. So we don't satisfy the client turnover test there, assuming 30% is our percentage and not 15% for charities. So what we have here is, well, there was an event that in August 2019, BISCO acquired a business. So August 2019 is in the smack bang in the middle of our comparison period, being the September 2019 quarter. So we don't have to wait to find events that occurred after the end. They can occur during the quarter. As you can see, the acquisition had this effect where, well, just before, the month before, we had $1 million turnover, and now it's 1.3 million in the month after. So you might say, well, the acquisition resulted in a change of turnover of 300,000 or 30% for the month, which might satisfy that change in turnover element. Now, obviously, a lot of other things could be impacting turnover, so maybe those could be explained completely by other factors. So that might not tell the whole story. But assuming we satisfy that element, we have this access to the alternative test. So instead of using the September 2019 quarter, we can now compare the month after the acquisition, being September 2019 alone, and multiplied by 3 to get us a $3.9 million comparison turnover. So we're starting from a much higher base, rather than 3.4 million. And using that, we can see the quarter in 2020, the September 2020 quarter, has declined by over 30% now, 33.3. Again, assuming we have a 30% percentage to use. Therefore, we can qualify for the first extension for those first 7 fortnights until the 3rd of January. Let's go through another example on the next slide, and this is another event. It's a disposal, and we have BISCO disposing part of its business in June. Now, here we highlight a couple of things. So this is in June 2020, and again, the basic test isn't satisfied, so we might look at the alternatives. So this highlights this no whole month rule. There's normally would look at the month following the disposal, the key events, and pick that up. But because there's no whole month prior to July, we use the turnover in June. Now, what you sort of notice here is that potentially some like an anomaly, because the June turnover is very high compared to the surrounding months. And this is because under the current GST turnover concepts that we're actually testing JobKeeper with, we do include things like capital sales, and that could include a GST-free sale of a going concern, and that would go in your turnover that month. And because we don't have the ability to pick up the next month because of this no whole month rule, we're right smack bang before our test period, we're stuck with using the turnover in that period where the transaction occurred. So using 2.5 million times 3 as our comparison period, we have this really high turnover to test the decline against, and you can see we satisfy the 30% easily. It's fallen by over 65%, which again, this might be an anomaly in these sort of situations. So you just think that carefully if it's appropriate, because the ATO might not, might not think this is an appropriate outcome, but that's kind of something that could arise under the rules. I guess just maybe highlights the point of what's the significance of a disposal? Normally we think we could restructure a business to cause it to turnover to increase, so we can sort of pick up a more later period to compare to, or acquire a new business. Normally we don't think of a disposal as increasing and therefore helping us have a higher turnover period, comparison period to test against. But as you might dispose of part of a business that was generating maybe lower turnover, but maybe higher margins. So, and then you switch to a high turnover, lower margin business. So maybe profitability overall is the same, but you've got a bit of a change in your turnover. So the disposal one is an interesting thought. But we have an example on this slide of potential strange outcome you might guess. Yeah, just some, I guess, things to consider for these tests. Just really reiterating the matters discussed, which is what does it mean to actually acquire or dispose or restructure a business or part of a business, and careful you're not actually commencing a new business, which would be a different test and could give you a different outcome. And just again, reminder, you can access the test if an event occurs during the normal comparison period. So you can end up using a month in that 2019 quarter rather than one after it. And lastly, question then, well, what if an event restructure spans multiple months? And just reiterates the first point, like these concepts aren't clearly defined. You have to potentially pinpoint, well, when did the restructure or acquisition actually occur and when did it end? So these might not be clear and there could be a bit of further investigation needed. So on that, I'll pass to Chanel, and she's going to discuss the substantial increase in turnover test, which probably one of the ones we see most often, given basically anyone can access it. It doesn't require any sort of special event to have occurred.
Thanks, Leo. While we probably do see this as one of the ones that people explore the most often, I, at least admittedly myself, find this one of the most complicated to get my head across. So I'll try and take it as slowly as possible. But broadly speaking, the test is available where the business has had a rapid growth in the past 12 months. In these instances, you can clearly see it's inappropriate to consider the turnover of 12 months prior to compare to the 2020 figures, so either September 2020 quarter or December 2020 quarter, because the business will generally have had this upwards growth trend. And so by looking at that trading 12 months earlier, you're not getting a sense of the decline in turnover because your baseline is starting out so much lower. Previously, the test looked at the growth in the 12 months prior to the test period. So if you were testing the September 2020 quarter, you'd look at the growth of the business prior to September. But for many businesses, as Alexis sort of foreshadowed earlier, the period leading up to these test periods has been significantly impacted by COVID. And so while the turnover may have been sort of steadily increasing upwards, the effect of that decline may have meant that they wouldn't be meeting these tests. So the ATO have provided this concession that businesses can now lock in that growth up until the 1st of March 2020, meaning you're essentially testing the decline against this higher benchmark. Finally, the main change that has been that the ATO has clarified the periods that you compare. So previously there was a little bit of ambiguity about how the test actually operated, but it's now quite clear, and we'll take you through that as well. So we'll walk you through the basics of the test first, and then we'll discuss the relevant periods in a little bit more detail. As I just said, the test applies where a business has had a rapid growth in the past 12 months. So the way that the ATO tests the growth in the business is to say that the business must demonstrate it had an increase in turnover of at least 50% or more in the 12 months before the test period, or 25% or more in the 6 months before the test period, or 12.5% or more in the 3 months before the test period. And alternatively, as I just briefly covered, the ATO has provided the option of instead looking at that growth up until the 1st of March instead. So basically looking at the growth in the 12, 6 or 3 months prior to the 1st of March, essentially allowing you to ignore those potentially COVID affected periods. If a business can demonstrate that it has grown sufficiently, so again, that the turnover from that earlier period is now no longer an appropriate comparison period, the Commissioner will allow you to instead use the turnover for the 3 months prior to that period. Now, as we've tried to demonstrate in the slide in front of you, it's not a mix and match approach. If you've demonstrated the growth in the business leading up to the test period, then you use the turnover for the 3 months prior to that. If you've demonstrated there was a growth in the business prior to the 1st of March, then you'll take the turnover for the 3 months leading up to the 1st of March 2020. So in my mind, one of the biggest benefits of the change to the test for JobKeeper 2 is the simplicity it actually affords this test. So before, you had a choice of a month or a quarter, anywhere from March to September, leading to a lot of confusion about what periods you were comparing at any given point. The requirement now that you look at the decline in turnover for either the September 2020 quarter or the December 2020 quarter, for either the first or the second extension period, does mean that there's only so many iterations of this test. So for the first extension period, what you can see in front of you, So for payments from basically this week until the end of the year, a business has two options to show that they're eligible to use this test. So the growth in turnover up to the start of the test period, so up to the 1st of July 2020, or the growth of the business up to the 1st of March 2020. As you can see, it essentially gives you 6 possible ways to satisfy that gateway test. So for example, you can show an increase of 50% or more from February 2019 to February 2020, or 25% from December 2019 to June 2020, or 12.5% from November 2019 to Feb 2020. So likewise, there are 6 possible ways to satisfy the gateway test for the second extension period. So again, testing against the December 2020 quarter. Again, you have the option of locking in that 1st of March 2020 date if you prefer. And the comparison points that you could use are in front of you on the screen. Now, just a reminder, again, this is what you need to meet in order to show that you qualify for the alternative test. It's not the actual test. So if you can demonstrate that your business turnover has grown by 50% or more when you compare the February 2019 figures to the February 2020 figures, then what you would do is you would take the 3 months prior to the 1st of March 2020 as your comparison and compare that to your December 2020 quarter. So to try and illustrate these two options, we've given you the example of BizCo. So in this scenario, BizCo won a new contract in October 2019. So its turnover has increased dramatically in the past year. So when BizCo uses the basic test, even though its turnover for September 2020 has declined, it hasn't declined sufficiently against the September 2019 quarter because it had such a growth in its turnover between those 2 points in time. So instead, BizCo looks to use the substantial increase in turnover test. So as you can see on the slide, if BizCo looks at the growth up to the test period, so up to the 1st of July 2020, its turnover has increased by more than 12.5% in the 3 months when comparing March 2020 to June 2020, meaning it's entitled to use the alternative test. It's important to note it only has to meet one of those conditions, so it can still use the test even though its turnover didn't increase by more than 25% from December to June, or by more than 50% from June 2019 to June 2020. And that's just a function of when the business started to grow. It only started to grow from October 2019. As BizCo satisfied that gateway test on the basis of the growth up to the test period, it can then use the 3 months turnover prior to the 1st of July. So it'll use the total turnover in the April, May and June period, which gives you a total comparison of 3.5 million. However, as you can see, BizCo won't satisfy the alternative test because the total turnover period for the period was only 3.5 million. So when you compare it to the September 2020 figure of 2.7 million, there's not a sufficient decline. You've only got a 22.86% decline in that period. But as we've already touched on, BizCo has another shot at this test by instead using the 1st of March 2020 as its comparison point. So again, BizCo satisfies the gateway provisions because it can demonstrate that its business grew by more than 50% in the 12 months before the 1st of March 2020. So as on the screen, you can see by comparing February 2019 to February 2020, but also that its turnover increased by more than 12.5% in the 3 months prior to March by comparing November 2019 to February 2020. Again, it doesn't matter that BizCo didn't also satisfy the third of those options, being the growth in the prior 6 months. Now, because BizCo demonstrated a sufficient growth prior to the 1st of March, it can instead use the turnover for December, January and February. And in this instance, it meets the test because its total turnover for that period was $3.9 million. And so it has a decline in turnover of above 30% for the September 2020 quarter. So you can see that there's a couple of options to get into the test. And then once you're completing the test, it does give you, again, that flexibility to show that from an increased baseline, the business turnover has declined, presumably as a result of COVID. And on this, I will throw back to Leo to take us through the irregular turnover test.
Thank you, Chanel. So I'll just recap again what the irregular turnover test is about. And essentially it allows you to smooth out an entity's turnover over a 12-month period where it may otherwise be lumpy in nature. So it might be unusually low in the 2019 comparison period. That's a 2019, September 2019 quarter, for instance. And there could have been like a big contract that was delivered on or after that time, or could be some event suppressing turnover in that comparison period. For example, it could be a contract that wasn't delivered, that was lost, or an industrial dispute, which makes the basic test not appropriate because maybe where our 2019 comparison period is unusually low. So, I mean, there could be various reasons, but the key is the turnover of the entity must not be cyclical. That is a sort of condition that excludes in entities from accessing this. So if what's happening is just a normal annual fluctuation, then the test is not available to you. So for example, a retail business may have a bumper Christmas trading period normally, or primary producers who have peaks based on when they harvest certain crops, they might most likely be considered to be cyclical and then won't be able to use this test. So I guess the idea is factors, if they affect the turnover in both 2020 and 2019, then we've got a fair comparison and we shouldn't get access to this test. So we should be able to compare September versus September quarters despite there being sort of lumpy turnover if it happens to be cyclical. And the explanatory statement does suggest that those in the development or construction business may access this. So even though their turnover may be seen as cyclical over the life cycle of projects, it's not cyclical over the course of a calendar year, so they could potentially access this test. And the main change that we want to highlight is similar to the substantial increase in turnover tests. We effectively allow to test immediately before our test periods, so that's starting on 1 July or 1 September, or use the pre-COVID period, which is immediately before 1 March. So we've actually got two ways we can possibly, or two options available to us. And also there was a change because there was some confusion in the original alternative test here around the use of the word quarters, whether that means any 3-month period, or does it mean the quarters as we normally understand them, ending March, June, September, and December, which also was a defined term in the tax legislation. So there was argument that that was the appropriate meaning. And this issue was, Peachy Partners has highlighted, and it's now been clarified. So now the use of that word quarters is gone. It looks at any consecutive 3-month period, which when we test for irregular turnover prior to 1st of March, we could be using some non-traditional, I guess, 3-month periods. So it could be ones from like March to May, or December to February. So it might be a bit of work involved because it doesn't align to your normal, what you report in the BAS. You might have to sort of reconstruct those 3-month periods if you want to apply the test. And we'll go through this in some examples further on. So here we set up the test. We'll look at the 3-month periods, 12 months immediately before either the test period or the 1 March or the pre-COVID period. And we split those up into 4 equal 3-month periods. And we look at the lowest compared to the highest, and we're seen to have irregular turnover if the lowest is less than half of the highest. Or alternatively, if the highest is more than double the lowest. Noting again the caveat about turnover not being cyclical. So if we can get past this gateway, we're able to then smooth out the turnover over the 12 months immediately before our test period, or before 1 March if that's the way we got in. So what we do is we take the average monthly turnover for those 12 months immediately before, we multiply that by 3, and we can use that to compare to our September or December quarter for our decline as appropriate. Effectively what we're doing is we're just dividing that 12-month lot of turnover by 4, because we're dividing by 12 and multiplying by 3. We're basically almost calling it an average quarter if it was smoothed out. And we'll just run through a couple of examples of this. So here we have BizCo. We fail, starting point was always start with the basic test, and we fail the basic test because there's no decline at all. We've actually grown in 2020 compared to 2019. But we find out, well, that's last year. The reason is because last year we had an industrial dispute in September, and we had an unusually low turnover there. And then things sort of picked up again very quickly after September. We had a really large turnover in the months there. We can see December to February 2020. So maybe, in fact, we recovered and pushed out the turnover out from September quarter into the months following that. And assuming that the turnover is not cyclical, we say here it's not. There was an event that caused our turnover to be suppressed. It's not just through the normal annual fluctuations. We're applying here again the 1 March test. So we're testing the 12 months before 1 March 2020, the pre-COVID periods, and we divide that into 4 3-month periods. We can see they are these things that aren't regular quarters. They're March to May, June to August, September to November, and December to February. And we work out the turnovers in those 4 periods, which might be a bit of work because again, they're not our normal quarterly reporting periods. And you can see the highest has 250,000 and the lowest is 75,000. Clearly, the lowest is less than half the highest. It's about 30. It's exactly 30% of the highest. So we can access the test. So what the test allows us to do is to smooth out the turnover over those 12 months. If we add those up, 150, 125, 75, 250, we get $600,000. And effectively, we just divide that by 4 to get a new comparison turnover of 150,000. So under the basic test, we're comparing to our 75,000 turnover. Now we're comparing to a much higher figure, double that, 150,000. And given our 2020 turnover actually was 100,000, it's fallen by over 30%, so 33.3. And this decline in turnover test is satisfied, and we can access the first JobKeeper extension. Now, given that we've satisfied we've accessed the test based on irregular turnover prior to 1 March, we can do this again for December because that's not going to change. It's for the second extension period. Although we would have to, obviously, our December 2020 actual turnover will change. So, presuming the December 2020 turnover is about 100,000 again, we'll also get the second extension. I'll qualify for the second extension rather, because that 1 March thing is fixed for both extension periods. But if we don't pass that in December, because maybe turnover went up to 120, there could be all sorts of other tests we could use. And this second example just highlights, well, we're not going to use the 1 March period. We're going to use the immediately prior to our test period alternative. So here we don't pass the basic test. Our turnover's fallen by 10,000 from 125 to 115, not quite 30%. But we do find we have a regular turnover, and we say it's not cyclical. Just it was lumpy for some reason, and the main reason here we highlight, if we're looking up to 1 July 2020, it could be that COVID caused our turnover to be suppressed in that June 2020 quarter. So it's a lot lower than the highest quarter, and we can access this test. So again, once we pass the gateway, we can smooth out that turnover over those 12 months prior to 1 July in this instance, which is 600,000. So we smooth it out, we get 150,000 on average. And that becomes our comparison turnover. Right? But all that being said, we still don't satisfy the decline in turnover test, even though we can use a slightly higher turnover to compare to. It's $25,000 higher, 150 rather than 125. That $35,000 decline only represents 23.3%, and that's not going to let us qualify on this basis. But again, could be you can use the 1 March period, or you can use other tests as well if you don't get through on this variant. So just some key watch outs, really just reiterating issues about, well, what does it mean for a business to be cyclical? Now, like for example, what about, if we have a startup, can we use it for those? And there's no reason why not, but I guess something to think about if you have a startup or even a commenced business, which there is also a commenced business test, we'll have little or no turnover at the start of that 12-month period. And if we do access this test, we have to smooth out the turnover over the whole 12 months. So we're picking up periods where there's really low turnover, and it might not be enough to get us a decline once we compare to September 2020 or December 2020. So you might get a better result using one of the substantial increase in turnover test, because you don't have to pick up the whole 12 months. You can use a more recent 3-month period, or the commenced business test likewise. And lastly, just an interesting interaction. And if you attended the previous sessions, we highlighted, and as Alexis spoke to before, we've got now a new commission determination around how we calculate turnover, and we're forced to use a GST attribution method to work out when suppliers were made to align to how we report in the BAS. Now, some other options are off the table now. And so this ultimately might turn on when certain invoices were actually raised. So we could get into situations where we've got no turnover at all in the September 2019 quarter. For example, it could be that the entity might just charge a management fee once a year, or maybe twice a year. It could be at the end of December, at the end of June, and there's nothing there in the September 2019 quarter. So we can't pass the basic test if we're our turnover comparing to is zero. But you might ask, well, can we use this test? Can we have an irregular turnover given it's very lumpy? It goes from zero to a large amount in the month that we do, or the quarter we do have the invoice. But the HM might argue, well, turnover is cyclical in this case. If you have this practice where you regularly invoice on, let's say, the 30th of June for your annual fee, that does appear to be cyclical, so that you might not get in there. So yeah, it's an interesting possibility. Yeah, we haven't got any guidance on this, but we're just highlighting possible things that could come up. On the other hand, you could get cases where you do actually invoice quarterly normally, but for whatever reason, it was issued a few days late. So the invoice for the September quarter was issued early October 2019. So again, you got a no turnover in the 2019 quarter BAS, but you might say, well, that's not cyclical in this case. It's, the turnover is billed on a regular basis. It just for some reason it was billed, the work was billed late in 2019. And so it's not cyclical here. Now we can access this alternative test and smooth out the turnover, which is obviously a lot better than using zero as your comparison turnover in 2019. And then when you get to the second extension, when you're testing the December decline, well, we don't have to use this test anymore. We can use the basic test, and it might be just our luck that we billed twice in the December quarter, once at the very, very start of October last year, and once maybe the end of December last year. And that, we might fall into this situation where we've got a decline purely because of that reason. So look, it might not be within the spirit of the rule, so just be careful when you're dealing with circumstances like that. But ultimately, because you can chop and change which test you're using for the first and second extensions, we could get into some sort of favorable outcomes. So that's all I wanted to say on irregular turnover. And we did mention there are other tests, and I'll just briefly touch on these. We did focus on what we think are the main four. So in the first two columns, we see there that these are rules that are available for sole traders, or what are called small partnerships, which have less than 4 individual partners. But the key is they have to have no employees. So these would only apply to get JobKeeper for one eligible business participant of that partnership, or the sole trader, because there's obviously no employees you can claim for. And when the test applies is where during the 2019 comparison period, the sole trader or one of the partners was away due to injury or sickness or leave, could be just an extended holiday, and might not be appropriate to compare the turnover because there's just no business, or really atypical sort of business conducted in that 2019 comparison period. And instead of using that whole quarter, we can take the month immediately before that sickness or leave happened and multiply it by 3, which might reflect a more normal trading period, and we multiply by 3 so we can get at least a quarter versus quarter comparison. Look, there is a key change here that compared to the original test for these ones, that we use the month before the injury or leave or illness rather than the month after as our comparison, which we multiplied by 3. Also, there are rules where the business is conducted in a drought or natural disaster zone, where that's affected the turnover, and it allows you to use a turnover in the comparison period in a year before. So maybe instead of using the September 2019 quarter, that if you're affected by this, you can use the September 2018 quarter as a more appropriate comparison. And lastly, note that we didn't go into these when we discussed the main 4 tests, but each of them has special adjustments for entities that qualified for bushfires, lodgement deferral programs, or able to receive these drought help concessions offered by the ATO, which again could just modify what your comparison period is to cater for those situations. But they just create sort of another level of complexity. So we probably don't have time to go into those, but just be aware if those things do affect you, there can be a further set of tests available. And just on that, I'll pass back to Alexis, and he's going to wrap up our presentation this afternoon.
Thank you, Leo. And thank you, Chanel, for going through all that detail on every one of the alternative tests that we think is going to be applicable to many entities trying to apply decline in turnover tests. What you probably realise from here is there's two probably key takeaways that come out of this presentation. One, these alternative tests are very complex and do require quite a lot of work in order to work out whether you're within those or not in those. And secondly, that they all apply as an alternative to the basic test, and you can essentially get into any of those and still get into the JobKeeper provisions. So if you're a entity and all you're doing is testing the basic decline turnover test, you're probably not doing yourself justice in terms of not working through and understanding whether you may otherwise satisfy any of the other tests. It really is important to work through not only the basic test, but all of the options that are otherwise available to you as alternative tests. Which comes to just my final part, which I just wanted to outline. What we've done is, Picture Partners, we've put together a calculation package that we're providing to clients that we're doing reviews for, so that we're engaged to provide assistance on looking at your JobKeeper calculations. And essentially, it is a package that will do all of the calculations once you enter your BAS information into the model. Essentially, what it requires you to do is enter your BAS details in for the months from essentially from February 2019 all the way up to current date. And once you've entered that detail in, it will then automatically calculate those 4 alternative tests, including the 2 variations for both the irregular turnover and the substantial increase in turnover, and help you determine whether you're otherwise within the basic decline otherwise in the relevant thresholds for that. It also does cover the basic decline in turnover test. This is to hopefully simplify the process of considering all those tests and also to make sure that they are being calculated in the appropriate manner. So if you do have a Picture Partners contact that you are working with and they are reviewing your calculations, please get in contact with them. The model will be available, released after today. And there are a number of conditions in terms of using it, including the completion of an appropriate GST checklist before any data can be submitted as a part of just internal controls over the model to ensure all the data has been properly inputted into that. Again, we're offering that to clients to assist them with their calculations as a part of this. I'll just leave this slide here that's got our contact details if you do need to get in contact with us. But please, if you have a Picture Partners contact and you have queries, questions, or anything in respect to JobKeeper, please feel free to reach out to your Picture Partners contact in respect of any assistance that you need. That will wrap up our presentation on the alternative tests. Again, I'd like to thank both Leo and Chanel for their presentation, and I'd like to thank you for attending this session. Have a great afternoon, everyone.